One of, if not the hot topic for 2025 is how active the Fed is going to be. If we go back 12 months, it was thought to be 6 rate cuts. I think today, then it was 4 rate cuts. I think today, if you were looking at the dot plot from memory, there is 2 rate cuts. But let's not forget, there was actually one brave Fed president that actually agrees with me, and that is we are going to have 0. Let's talk to Taylor about how active the Fed's going to be. Taylor, what say you? What's going on?
I think it's a fascinating point. And I tend to agree with you that although it's not most likely, right? We're out on a limb saying this, but I think the data says that 0 rate cuts is probably the right decision to be made unless we see a meaningful, dramatic change in some of the underlying data, which it'll be data dependent. We know that.
Yeah, I think it's really funny. I really do feel good about my 0 call through Q1 and Q2. I think that's almost a layup at this point, which is really funny because when I started talking about 0, it was like 6 months ago or 4 months ago. So I was really early. Back when the Fed was talking 6 cuts, I'm like, dude, we're gonna have 0.
Well, if you look back to the beginning of our conversations, consistently, what we've been saying is less cuts. Like if there's been one theme, it's been less cuts. The number of cuts that we've been forecasting or whatever it is, we've said the market's just crazy with the number of cuts.
Yeah, wasn't it like 9 at one point or something?
Yes. It's like, what are you guys watching?
It's really funny. It's curious. I hadn't planned to ask this, but I want to. I actually came out after the Fed made their cut in December, and basically said it was a mistake. I think Jerome Powell inadvertently told the market what was coming and didn't have time to back it out. I think the December cut was a mistake. I think the Fed knows it was a mistake. And I think if you gave them true serum, they wish they didn't cut. What do you think?
Totally agree. I said going into that meeting in some of our videos, like the Fed's going to cut and they shouldn't cut.
Yeah.
You have inflation move the wrong direction. Like,
and the job market got stronger. It's like,
I mean, what are you looking at? Yeah, you're looking at employment and you're looking at inflation, and neither one of these numbers are alluding to the fact that you should be moving downwards. There's this fictitious thought out there of this neutral rate. Well, if the neutral rate is not one, let's not just talk about this fictitious thing. What you're talking about is the neutral rate is the point at which you're neither stimulating the economy nor are you restricting the economy, right? Well, if inflation backing back up and unemployment sinking lower is not, okay, maybe it's not being restrictive, but it may, or maybe it's not being, whatever, you get the point of this. You're not slowing down the economy. Yeah. What is the need for continuing to reduce rates moving forward? The data is just not there.
Yeah. And the other thing, again, that I've been talking about for a long time, and I think the Fed has finally acknowledged, is we have a new administration coming in, and we just don't know lots of things, right? Tariffs, deportation, just tax cuts. There are so many things that could go one way or the other. There are legitimate, you could look at what's coming and go, that's inflationary. That's like really inflationary.
I don't think there's any argument against that. And again, political thoughts aside, like there's 3 tenets, core kind of tenets to the overall new administration coming in. One is lower taxes. That's inflationary. If you and I all have different, more money in our pocket to go out and spend on God only knows what, we're going to spend it. That's what Americans do.
Yeah, exactly. Have we not learned anything?
Oh my God, right? The second one could be argued that it's deflationary, and that's deregulation. If we start taking out red tape, that's certainly a positive.
Yep.
And then the third one is tariffs. Like tariffs, there is no argument on planet Earth that I want to hear that they are not inflationary. It's just you cannot say whatever the cheapest producer globally is on this. Free markets allow the cheapest person globally to produce something that can do it efficiently and bring it in without taxing it. Well, tariffs are the tax. Therefore, it is literally driving costs higher. And then if there's retroactive tariffs tit for tat, then obviously it creates this spiral effect upwards. And deportation, to your point, like that's not
labor. Labor. If you go into the labor market and you remove millions of workers, that's inflationary. It just is.
Yeah. And what's one of the areas in the market that's had the epicenter, your world, of inflation targeted on its back is real estate, right? And if you look at, it depends on what study you look at, but roughly 40% of construction workers are apparently non-US born. And a lot of them are the ones that apparently are part of this deportation. And so therefore you lose a lot of the construction workers. What's that do to input costs in an asset class that's already inflated 40% in a 3-year period of time?
Yeah. The other thing to think about is one of the things I'm watching is the 10-year note. I think it's about 4.6-ish, 4.62, something like that this morning. If it could be 5% in a heartbeat. The 10-year note could be 5%, call it into February. It really could. And that, to your point, higher for longer, a 5% 10-year means owner occupied loans are probably 7 3/4. Investor loans are probably 8.5. And that means that the real estate depression, right, in transactions is not over. It's funny. I look at it happening, and I actually am calling for real estate transactions to be down in 2025 from a dismal 2024, right? I think it's expected existing home sales will come in at 4.04 million. I think we print a 3 handle in 2025.
It's tough to see what the recipe is for increased sales, right? Barring potentially you get this massive compression in rates, which again, none of the data is leading us to believe there should be some
not in the first half.
No, right? So if you don't have that coming off, we don't have this massive increase in supply coming to markets. Where is the transaction velocity going to pick up from? I don't know.
Yeah, I don't know. Again, I think at the end of the day, and if you just want to carry this one step further, that's residential, right? Residential slow transactions, but let's roll it over to the commercial area. I think if we have a 5-year, 10-year, I really believe this, and I'm actually setting up my playbook to run this play. So this is like real money going to work. If we get that 5% 10-year. I think this whole bullshit extend and pretend of the commercial real estate market blows up. I think there was a lot of people I think there's like 1.8 trillion that was rolled over into this year. Extended pretended this year already had $1 trillion. So we're, damn near 3 trillion. I think if we get a 5% 10-year, banks just give up. They're like, screw it. And that just means recognition that there'll have to be some foreclosures in commercial real estate. Because again, nobody's going to, you're not in pain if you got a 3% 30-year, but you're in pain if your rate was 3% and now it's 9.
Yep.
Blows up.
So maybe that is one thing that actually causes a little bit of pickup and turnover in the fact that like things actually transact just at a forced.
Right now we have no price discovery
in
Class B and Class C. It is interesting to note, and you may not see this because this is my world. Class A is retrading. Right now, it is trading between a 25 and 30% discount to last price. But Class B and Class C, not trading.
So cap rates are just markedly moving higher then as these things reprice at lower rates. Yeah, we have one of the managers that we utilize in the real estate space. Real estate is, in our opinion, one of the very few areas of the market where there is real value. But you better damn well know what you're doing on the commercial front. On the residential front, like things have never really come off the boil. But on the commercial front, it's really where there's value. And right now, the value as the manager that we utilize, where we give them flexibility to buy the debt, private or public, or the equity, private or public. Right now, they're sitting on 100% debt because they can get a higher yield than they can cap rates in the market. The market's just upside down. And at some point, they're thinking that price discovery will start to come to fruition. You'll start to have transactions roll through the system and they're going to be at lower prices. Cap rates are going to pop on the other side. And all of a sudden, you're going to be able to get 2x the cap rate you are on the yield on the bond. And that's where the risk reward starts to make sense again.
That is awesome. Well, Taylor, you're amazing. If somebody wanted to follow you, go to Life Goal Investments on IG or lifegoalwealthadvisors.com/introduction. Taylor,
you're the man.
so much.
Thank you.